Right. Last week we were looking at accounting concepts, and we went through few concepts. We went through business entity, money measurement, going concern, accounting period, and then we went on to look at periodicity. Right. So today we are coming back to a important and most vital concept that is there in accounting. So which is the accrual concept. So accrual is something that becomes due, specially an amount of money that is yet to be paid or received at the end of the accounting period, right? So in terms of the definition, this is what it says. Accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. So now by this time you all are aware that what is accounting period is. So when you say accounting period, there will be 12 months in the current context, and within these 12 months, what will happen? Your business transactions may include where you would have received money physically, you would have paid money physically. But this concept is not talking about the money that you would have paid or received. This concept is all about the income and expenses that you may recognize in your financial statements in terms of either incurred or accrued. Accrued in the sense, that is what this concept is. So we are talking about in terms of revenues or expenses that are recognized when they become receivable or payable, without looking at whether we have paid cash or received cash, or whether we have not paid cash or not received cash. Okay, so let me explain this with the board so that you will be clear with that. I hope everybody can see the board. Now let us take a timeline. So we talk about an accounting period which is starting from 0 to 12 months, and we know I hope you all can see the board. Is the board visible to you all?
Yes.
Right. So now we are talking about the revenue or the income that is received or an expense that you may have incurred. So what are we talking about here is, let's say you are supposed to incur electricity. Now this electricity is consumed in every month of this accounting period. Okay, so let us first look at an expense. Now the electricity is consumed in every month of the financial year or the accounting period. Say for example, the electricity that is consumed in the month of January, you will receive a bill probably in the month of February. Okay, that is obvious. We know all of us know that that is what the current practice is. So as we go on, you will see in the month of December, you have already consumed the electricity, but the bill for same will come in the next financial year. So let us assume that this is 2020. If that is the case, you will receive this bill in January 2021. Okay. Now look at this same example in terms of you pay the electricity bill. So January bill will be paid in February, February 1 in March. Likewise, you will go on and pay up until December, assuming that you have paid the bills regularly. So the bill that you would have paid in December would be for the month of November. But what this concept says is, even though you have not paid the bill for the month of December, which was actually paid in January 2021, you need to consider that as an expense which you have incurred. Otherwise, what will happen, if you take the accounting period, you might have paid electricity bills for 11 months, whereas your company has operated for 12 months. So if you have operated for 12 months, which means you have an expense for the 12th month also. Now someone might argue, what about the previous year? That is the year before. You might say that the bill for December 2019, I would have paid in January. So why should I take this into this current year? No. Forget about this. Let's start fresh. So if this is what you are going to do, automatically, every year you will consider the December month expense in the particular year so that the January payment is not relevant. Okay. So what does it mean? Paying the electricity bill and incurring the expense are two different and they are not related. Payment of the electricity bill can happen anytime because that is cash receipt involved. Sometimes I might say, even though I have consumed electricity for January and February, I might pay the bill in June. I think that is what happened currently under this COVID-19 pandemic. All of you know, we didn't get bills for April and May during those months. So we got the bill only in June. But what would have happened? During those 3 months, March, April, May, obviously maybe in the early part of June, we were consuming electricity. I think we would have consumed more than what we have been consuming when we were working and operating. So obviously you will know that payment of the electricity bill can happen at any time, irrespective of your consumption. So the accounting or the accounting bodies or accounting standards have brought up this concept called accrual concept, which talks about don't look at the payment or what was paid. Look at whether you have incurred that expense or not. If you had incurred, then you need to recognize that in your financial statement. So as we go on, you will understand. Now you might raise a question. For January, February, March up to November, the consumption has been up to date paid, means by when you reach December, I have paid the bills for all 11 months. But for the December month, I will receive the bill in January and I don't know how much to pay. So how can I recognize an expense here? The answer is very simple. If you are a person consuming electricity on an average basis, you can assume the bill that you have received in in December pertaining to the month of November will be same as for the month of December. Unless otherwise you know a particular reason for which the electricity to go up. So thereby, we will consider a period of 12 months in which I have consumed electricity, which means I have incurred the expense. I have incurred the expense, not the payment or whether I have paid or not. So the expenses, accounting for expenses in this manner is generally known as accrual. Accrual, where even though you have not paid for it, you will accrue that expense in your financial statements. Now this is an expense. Now let us talk about an income. I would easily take the easiest income would be the rental income. Let us assume that you have rented out your house to somebody who will pay you a monthly rent of 10,000. So if that is the case, generally what happens, mostly people might pay the rent on the particular month. Pay the rent on the particular month. So assuming that you get the rent on every month, and on that basis you account for it in during your financial year. But what happens apparently from the month of October, you don't get your payment. You don't receive. Earlier we said that it is a payment. Now you don't receive your rent. So which means your tenant, the person who is occupying your house or office premises, has gone abroad. Since he has gone abroad, he is not going to pay the rent for the next 3 months, and he is going to come back in the next financial year of yours. So which means you have to now consider a period of 12 months, which is again January to December, and I have received rent income only for 9 months. But I know for sure because I have an agreement with the tenant where he has to pay me these 3 rents. And if your rent is 20,000 per month, this is a definite income for you. That we call as income receivable. Income receivable, like the expense incurred, this is an income receivable. So irrespective of whether you have received cash, you have to recognize the income for the 3 months in your financial statements or the accounts that you prepare for the relevant accounting period. So this concept is talking about the income that you have already receivable, which is receivable to you, but you might have not received it in cash. Similarly, the expense that you have incurred, but you have not physically yet paid, have to be recognized in your financial statements. So where do we get this from is the accrual concept. Okay, so accrual concept only gives us this guideline or the principle to prepare financial statements on that basis. That is, you have to recognize all income which is receivable to you, irrespective of whether you have received cash or not. And similarly, you have to recognize all the expenses that you have incurred, irrespective of whether you have paid or not. Okay, is that clear? So I would like you to take down this, what is on the board. I'll give you about 2 minutes. Quickly take down. Okay, let's go back to the presentation. So what does this particular concept says? Accrual is something that becomes due, especially an amount of money that is yet to be paid or received. That is what I explained now. At the end of the accounting period. So at the end of the accounting period means when you reach the financial year end, if you have incurred the expenses, even though if you have not paid, it need not be one particular month. It could be for several months also. So if you have not paid, you have to recognize all those into your financial statements. Similarly, an income which is receivable to you, if you have not received it, then again, you have to account for that also. That is what this accrual concept is. And please make a note that this concept is very, very, very important. Because even if you are not doing accounting or any other, this will be a concept that you are supposed to remember. Because for every revenue that you come across or every expense that you come across, it needs to be accounted in using this accrual principle or concept. What is the significance? It helps in knowing actual expenses and actual income during a particular time period. So you can now understand why it is important. If you don't do this on the accrual basis, what will happen? You might have paid the electricity bill for only 6 months or maybe 7 months. But actually you know that you have consumed electricity for 12 months. Similarly, you would have taken the rental income only for about 8 months. But actually you are supposed to receive for 12 months. So that is where the accrual concept becomes very, very important. Further, it helps in calculating the net profit of the business. So you need to understand why it says it helps calculating the net profit, because I'll give you an example. Let's say you have incurred a big expense, okay, which is like a maintenance to your building. Now this expense have to be incurred in the current financial year. But due to some reason, the contractor does not give you the bill during the current financial year. So what happens? Automatically the bill will come to you in the next financial year. But you know you are supposed to pay for this in the next financial year. But you have incurred the expense and the benefit out of it is already taken into the current financial year. So if you don't consider this, your profit will be higher. Why? You have not deducted an expense which you have already incurred. If you have not calculated your net profit using this expense, then what will happen? You will distribute more to your shareholders as dividend. This is what happens when companies, when they don't calculate their profits properly and distribute more profits to the shareholders. So it is very important that you make a note. All income and expenses have to be recognized using the accrual concept to ensure that your net profit is calculated correctly. The next one is also in line with what we learned under accrual concept. This is called the matching concept. It states that the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. Simply the example that I spoke to you just short while ago. If you have done a maintenance to your premises, why you are doing it? To see that your premises look nice and more customers come due to that, various reasons. So the benefit out of your modification, or maybe you may have done the maintenance, will attract more income to the business in the current financial year. So if you have attracted those income in the current financial year, which means you have to recognize the expense also in the same period. So the matching concept says the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. It can't go to the next financial year. That is, you have the income in this financial year and the expense in the next financial year. So what does it mean? Once the revenue is realized, the next step is to allocate it to the relevant accounting period. Which means if you have an income which pertains to this financial year, you can't defer it to the next financial year, because you would have incurred an underlying expense for that particular income to be earned. What is the significance? It guides how the expenses should be matched with the revenue for determining exact profit or loss for a particular period. So, which means, let's take an example of your own bank, where you serve your customers from every day 9 to 5 on weekdays. During this time period, you incur a lot of expenses. But for these expenses, you might have not directly paid during that period. Now, using all these expenses that you have incurred, you are generating income because your customers are coming and you are serving them and you are getting an income. So the income that you generate is actually as a result of the expenses that you have already incurred. So what does the matching concept says? The income that you have generated is a result of the expenses that you have incurred. So you have to have like with like. That is, whatever the expenses that you have incurred during the current period have to be accounted in the current accounting period. You can't take it to the next financial year because the income that you have generated relates to those expenses. Secondly, it is very helpful for the investors or shareholders to know the exact amount of profit or loss of the business. So if you overall look at it, the accrual concept and the matching concept go hand in hand, which means you can't differentiate the two. You have to look at it as one. The accrual concept and the result of that is covered in the matching concept. So both go hand in hand for accounting purposes. Periodicity we have already gone through. So let us look at accounting cost concept. So the accounting cost concept is very straightforward. That is, for every expense that you incur in your business have to be accounted for using the historical cost convention. Or else you can make use of, which is called a fair value I don't want to introduce that term at this point in time because there is more lessons which are coming up, talks about fair value. So we will discuss at that point. But simply taken, you can assume the expenses that you have incurred should be accounted at their purchase price. Purchase price means there will be a price shown in your invoice or the bill that you get. So that will be the price that you account for all your expenses as well as assets. Say, for example, you go and buy a computer. So the company will give you a bill for the computer that you have purchased. Let's say the price of the computer is 120,000. And you have got a discount and so on. Let's forget about all those. But you know this computer is actually worth 130,000. Due to the special offer that you got, you have bought it at 120,000. So now here comes a problem, whether I should have this computer in my books at the rate of 120,000 or at the rate of 130,000. So that is where the accounting cost concept comes. The accounting cost concept says that all assets are recorded in the books of accounts at their purchase price. So what is the purchase price in this scenario? It is 120,000. The asset would have been 130,000, but with the special offer that you got, you have only paid for 120,000. So that will be your purchase price. This is where accounting concept comes. You have to account for all the assets that you have purchased in their purchase price. And if you look at the last line of the definition, it says, and not at its market price. If you are having a handout, please underline that. It is not at its market price means what I told you now. The computer may be at 130,000 in the market, but that is not relevant to me for accounting purposes, because what I have paid is my purchase price is only 120,000. So I have to account for it at that particular cost. So we have a term called historical cost. Historical cost means the price that you have paid to buy this asset. So the historical cost convention comes from the accounting cost concept. What is the significance? This concept requires assets to be shown at the price it has been acquired. Acquired means purchased, which can be varied from the supporting documents. It helps in calculating depreciation on fixed assets. I told you that we have to learn LKS 16, which talks about depreciation and so on. So we will take it up at that point in time. The effect of cost concept is that if the business entity does not pay anything for an asset, this item will not be shown in the books of accounts. So even though this says that if you have not paid for an asset, it is not correct for us to take it into our books as part of our assets, because you don't have the ownership of the asset. So you know when you pay for it and then the title of the asset get transferred to you. So that is where you become the owner of that particular asset. So as long as you don't pay, it doesn't belong to you. If it is given as a donation, then there is a separate way of accounting for it. So those are out of scope at this moment. So let us forget about that. For the time being, you have to remember that if you have not paid for an asset, then it is not correct for you to record it in your books of accounts. The next concept is materiality. The concept of materiality states that financial information is material to the financial statements if it would change the opinion or view of a reasonable person. So we know that financial statements are prepared now for the stakeholders. Now, earlier we said it is to our shareholders. Yes, that prevails still. But you know that it is not only the shareholder who reads this financial statement. Now it is a larger audience. There are more and more users of the financial information. Now, what is mean by materiality concept is, let's say, you are not giving a material information to the reader in your financial statements. Okay, I'll give you a simple example. Let's say there is a huge fire that took place in your factory last year. Now, the result of this fire is yet to be estimated. Let's say the loss you can't identify yet. Now your financial year is already ended and you have prepared your financial statements. So you might say, this is my profit is. The shareholders will look at it and they will feel very happy because they have a large profit. If you go and not disclose the shareholder or the stakeholder that there was a fire that happened in the factory of yours and the loss of which is not yet estimated, then the shareholder might not have that material information to make their decision. Because what will happen, if you show a higher profit this year without telling that the fire occurred, the investor might think that he can get more and more return out of your company when he comes and invests. But what is going to happen? In the current financial year, you might have estimated the loss arising from the fire that occurred last year, and there would be a huge loss to your company. What would be the situation? The investor who has made an investment in your company based on your last year's profit is now at a loss. He will not have a return because the company will be drawn into a bigger loss in the current financial year. So it is very important that I provide the reader or the shareholder or the stakeholder any material information in my financial statements, which would change the opinion or view of a reasonable person. The term reasonable person here is anybody who can read and understand the financial statement. Now, we don't prepare financial statement for a small kid who is about 3 to 4 years. It doesn't make sense. So the term reasonable person here is anybody looking at your financial statements and a person who can read and understand the contents of your financial statement. So it is very important, if there is any material information that you need to provide to the reader of your financial statement, that needs to be disclosed. Otherwise, it might have an impact on the decision or the opinion that this particular person takes about your financial statements. So what is the significance? The concept is relative in size and importance. Most of the time, financial information materiality is judged on qualitative and quantitative characteristics. So let me go back to the same example, the fire that took place last year in your factory. Now this has two impacts. One is a qualitative factor, the other one is a quantitative factor. We understood that what is the quantitative factor? That is, you have incurred a fire and the loss of the fire is not yet estimated. So it could be millions and billions, which we don't know. What is the qualitative factor here? Due to the damage that has caused to this particular factory, there would be a situation where you might not be able to run your production in the current year. So as a result of this production being stopped, you might not be generating any revenue in the current financial year. Further, the impact of this fire, if it is a large one, there might be loss of lives as well as loss of business or employment opportunities to the employees who have been working. Because if you can't start your manufacturing again, then there is no job for these people who have been working under your factory. So the materiality depends on not only on quantitative characteristics, that is numbers, there are qualitative factors also. And secondly, it is relative in size and importance. What I mean by that is, irrespective of the impact, the amount also matters. For certain transactions, even 5 million could be very important. But in certain transactions, it could be even 50 million, which may not be relevant. So you have to look at this materiality in terms of the value that is in size and its importance, whether it will have an impact in the business or your profitability. So I forgot to mention that the materiality actually becomes an accounting convention. So prior to that, we were looking at accounting rules, you would remember. Now this becomes under a accounting convention. Convention means what had been the practice. So materiality is very important in terms of an accounting convention because the impact of the transaction may be very vital for the decision maker. So it is the duty of the person who is preparing the financial statements to make sure that any material information is not avoided from the financial statements. You have to provide them. The next accounting convention is, which we call as the prudence concept. Like the accrual concept, this is another pillar in accounting concepts, which we call as prudence concept. So you might have heard this term. What is prudence is? Let's look at it. The rationale behind prudence is that a company should not recognize an asset at a value that is higher than the amount which is expected to be recovered from its sale or use. Okay, so this might look like very little complicated to you all, but let me explain it in a simple term. So we expect that you buy in an asset. Okay, let's say you buy in a machine which is going to be used in your factory. Now this machine is expected to produce, let's say, 100,000 units in the next 5 years. Thereafter, the machine may not be able to be used. So you can calculate the 100,000 units that you are going to produce can be sold at a certain price, and what would be the value that you will derive from the sale of these units. Now, what do they say? The rationale behind prudence is that a company should not recognize an asset. Asset means the machine here at a value that is higher than the amount which is expected to be recovered. So after using it for 5 years, if you think this can be sold for some amount, okay, then you should not recognize it at a value higher than that. Okay. So basically, this prudent concept, in other words, talks about what we spoke about under historical concept or accounting cost concept, where we said we will record the asset at its purchase price. At its purchase price. So the purchase price is the convention or the concept that you use to account for assets. But the difference between that and prudence is prudence talks about both assets and liabilities. Now, what does it say under liabilities? Liabilities of an entity should not be presented below the amount that is likely to be paid in its respect in the future. Let me give you an example. Now we go back to the example that we looked at, the electricity bill. Okay. Now the electricity bill that you normally get, let's say it is about 50,000 per month. So you know the next month electricity bill also, if you have been consuming electricity in the same way, it should be somewhere around 50,000. But you can't say that next month the bill might be coming down and I will only have to pay rupees 20,000. Which means you are underestimating your liability. Whereas you have been paying 50,000 normally, now you say in the next month I will need to only pay 20,000, which is not a likely situation that is going to happen. So what does this prudence concept say? Liabilities of an entity should not be presented. Presented means you have to account for it below the amount that is likely to be paid. You see, you are accounting using the accrual concept. So you create a liability which is to be paid in the next month or maybe next year, and the liability should not be understated. If it is 50,000, you have to say 50,000. You can't say it 20,000. So what does the prudent concept say? It looks at both the assets as well as liabilities. For assets, it says you should not recognize an asset at a value that is higher than the amount which is expected to be recovered from its sale or use. On the other side, it says the liabilities of a company should not be presented below the amount that is likely to be paid. So in a nutshell, we can say you should not overstate your asset value. You should not understate your liability value. So I want you all to take down the summary of this prudence concept is that it says you should not overestimate your asset value and you should not underestimate your liability value. Okay, you should not underestimate your liability value. Now, what is the impact of this if you don't do it? There is an inherent risk that assets and income of an entity are more likely to be overstated than understated by the management. Very clear. That is what I told you now. Whereas liabilities and expenses are more likely to be understated. So by looking at the significance, you need to understand. Now, if you go and show your assets overstated, then people might think, oh, this company is having a larger amount of assets because they look at it in terms of value. But actually speaking, the value is much more lesser. On the other side, by looking at the balance sheet, you might say this company has only this amount of liabilities. So they think that the liabilities are very small. But if you really look at it, the liabilities are very huge. So what does the company is doing? They are showing a lower liability, which is favorable to them. So the prudent concept says you should not be doing this as an accountant. Your assets should be at the actual value. You should not be overstating them. And your liabilities should be at the correct value and you should not understate them. That is the summary of prudence concept. The next concept that we are trying to understand is the timeliness concept, timeliness. This refers to the need for accounting information to be presented to the users in time to fulfill their decision-making needs. So it's very straightforward. Now, you know, in the current context, some of the December companies, they were preparing their financial statements, and most of them published their financial statement prior to March 31st. Majority of them managed to do it. Then came the COVID-19 pandemic. So this started in Sri Lanka, I'm saying. This started somewhere on mid of March. So the companies which were closing their financial year as at 31st March were unable to close their financial years, and some of them were not in a position to prepare the financial statements even. Why? We were under a lockdown for April and May. Now, due to this reason, what happens? The financial information that you are supposed to provide to your shareholders will get delayed. And you prepare your financial statements or start preparing it only in June or July. So by the time it reaches your shareholder, you will understand already the next quarter is ended. Why? If a 31st March company, the first quarter of them is 30th June. So providing financial information after a time delay means that is of no use. You have to provide the financial information on a timely manner. Then only it becomes useful to the decision maker. Why it is said like that is because in today's context, decisions have to be made very quickly. Otherwise, the investor might lose a huge sum. So the timeliness concept says, as a responsible accountant or the accounting body, you need to be responsible in providing the financial information on a timely manner. If you delay the process of preparing your financial statements and providing it, then it becomes obsolete in the hands of the user or the reader. Okay, so this timeliness concept is very important when it comes to the banks, because banks has a separate guiding principle which is issued from the Central Bank of Sri Lanka. So we will look at it under regulations to banks, where the guidelines are given to the banks when they should publish their financial statements. And when it comes to the listed companies, the Colombo Stock Exchange has given guiding principles when they are supposed to prepare the financial statements and produce to the shareholders. So there are strict deadlines. But like what happened this year, there could be situations where abnormal conditions might make a delay or might delay the process of preparing financial statements. So the COVID-19 pandemic, which was not expected or and totally unexpected thing that happened, but in regular terms, you have to ensure that the financial statements are prepared on time and made available to the reader or the decision maker. So the same thing is being put here. Timeliness of accounting information is highly desirable, since information that is presented timely is generally more relevant to the users, while conversely, delay in provision of information tends to render it less relevant to the decision-making needs of the user. So which means if you delay it, it becomes obsolete in the hands of the reader. So full disclosure is another concept which talks about that the company must disclose all the information that would affect the reader's understanding of the company statement. So this is again going back to what I told you. Any material information or any important information which might make an impact of the reader's understanding or decision, then you need to disclose them. Disclose means provide them in detail in your financial statement. This is known as full disclosure, full disclosure. And for banks, there are a lot of disclosure requirements, which has been issued either by Central Bank of Sri Lanka or from the Institute of Chartered Accountants of Sri Lanka, because banks are highly regulated and governed. So their disclosure requirements are very huge. So you have to go through a financial statement, which is the annual report of a bank. Then you will understand the financial statements of a bank may run into about 200 to 250 pages, which covers the primary financial statements and the notes to the financial statements, because that amount of disclosures are made in the financial statements of a bank. What is the significance? Information that must be disclosed include knowledge of future events that are likely to happen and will have a significant impact of the company's finances. As I told you, an event that has occurred or maybe an event that is going to happen in the future have to be disclosed in your financial statement, because that can have a significant impact on the reader's decision making as well as the company's finances. Users of financial information become more informed to make better decisions. So if you provide the full detailed information, it helps the reader to make more informed decisions. So that covers the accounting concepts. So I would like you to ask any questions if you have before we get on to the next topic. So do you have any questions? You can also send it as a chat if you want. Okay. So can you all see the chapter 5, which is our next topic? Can I get a feedback, please? Is it visible to you all?
Yes, sir.
Right. Okay. So we are starting with a new topic, which is books of prime entry. And I hope all of you already got the handouts or maybe the PDF version of the handout. So this we are talking about the books of prime entry and journals. So we have now come to the 5th topic with the introduction that we had for the accounting, and now we have gone through the concepts. So little by little we are getting into the complex areas. Okay, right. So what do you mean by books of prime entry? In order to understand that better, let us first try to understand this cash versus credit transactions. Now, you know, in day-to-day business, we enter into transactions, and these transactions are mostly of 2 types. One we call it as cash, the other one is credit. Mostly the business concerns, they enter into these 2 transactions very frequently. So very often they do cash transactions as well as credit transactions. So you need to understand what is a cash transaction is and what is a credit transaction is, because that will be the starting point for us to learn how these books of prime entry will help these businesses with regard to cash and credit transactions. But this is slightly different to the operations of the bank. You need to understand that also, because even though we are looking at from the point of view of the bank, our ultimate objective is to evaluate customers who are non-bankers. So we are learning this subject or this entire module in order to understand better the financials of our customers, which are the companies or individuals or SMEs, whatever you may call it. Those are the customers of the banks who are not bankers. So mostly their transactions are widely cash or credit transactions. So what do you mean by cash transaction here? The cash transaction is where buyers choose goods to be purchased and the payment is made immediately. Very clear. If you are a supplier who is providing, let's say, plastic goods, so when people buy goods from you, might say, these are the plastic goods that I have, so you can choose one of those according to your choice, but the payment has to be made immediately. So what does it mean? You will provide that plastic item or whatever, let's say plastic a doll. The doll will be sold to this particular customer if the customer pays to this company cash immediately. So which is, we say, payment is made immediately. Similarly, there are something called credit transactions. So what happens in the credit transaction is where you will say the credit is offered and the payment is made at a later date than the delivery of goods. So I would like to make use of the board at this point in time, and I hope you will see the board. Now let's take this example. So let's say there is a toy company. This person is selling toys to the local market, and he caters to both type of customers. Both type of customers mean the retailers and the wholesalers. So let's take the transaction of this company with a retailer. Retailer means like you and me, any individual who will go to buy a toy from this shop. So let's say this retailer buys a doll. Buys a doll. Let's say Mr. A. Mr. A buys a doll, one doll only. Okay. So when he purchases this one doll, he goes to the shop, he selects out of the many dolls in that shop, and he buys one, and the cost of this doll is, let's say, rupees 1,200, just for example. So what he needs to do is, he needs to pay for this doll. That is payment immediately. Payment immediately. If you say payment is immediate, then it becomes a cash transaction. A cash transaction. So what does it mean? Mr. A has to pay immediately this 1,200, then only he will be allowed to take this doll home. If not, he can't take this doll. Okay. So I hope you understood what a cash transaction is. Now let us look at another transaction where another company called ABC company. This company is located, we'll say this toy company is in Colombo. And this toy company is in Kandy. So this toy company comes and purchases, again let's make it very simple, that he purchases dolls. And the amount of dolls he is going to purchase, let's say 2,500. So he is going to buy 2,500 dolls at once, which is the transaction. And obviously I told you he is a wholesaler. Okay, ABC company is a wholesaler. Now, this person bought only one doll for 1,200, but this person is going to buy 2,500 dolls. So as a result, he will try to bargain with this person. And as a result of the bargain, this person agrees to sell these dolls at a price of 1,000 each. 1,000 each. And these two have been doing business or having business transactions for a long time. And because of the good relationship, ABC company would like to take these dolls to Kandy and sell it in their shop, and would like to pay this company, toy company, later. So which means the ABC company does not want to pay at this moment. They want to pay it after a certain period of time. So they talk to toy company and they come into an agreement. So where the toy company says, okay, you are a good customer of mine, you don't need to pay now, you can pay later. So the payment is later. Payment is later. So when you say payment is later, there should be an agreement of when. You can just say payment later. Okay. So the transaction has taken place today. You can pay me within 60 days. Within 60 days. So what does it mean? ABC company purchases these $2,500 at 1,000 rupees, and they will take the goods to Kandy, but they are supposed to pay $2,500 at the rate of 1,000 rupees within 60 days from today. From today. So what does it mean? Goods have been delivered, but the payment happens later. Payment happens later. That is called a credit transaction. That is called a credit transaction. Is that clear? So in this transaction, this retailer will buy the $1 and pay 1,200 rupees immediately. That becomes a cash transaction. This wholesaler buys $2,500 from this company, which means at the rate of 1,000 rupees means 2.5 million rupees. The 2.5 million rupees will be paid within 60 days from today. Within 60 days from today. Why? The goods are already given. So when you reach this kind of an agreement, that becomes a credit transaction. So this is what you are doing even with the use of a credit card. Simple as that. For banks, the credit transaction that we do is actually offering the credit card, where our customers will go and use the credit card in one place, and we will give them a 51-day credit period for them to pay. So obviously speaking, the banks are also doing credit transactions, but in a different scale. Why? We don't sell goods. We don't sell goods. So it is, we are only supporting the financing transaction, the credit transaction. So in other words, now for a normal business concern like this toy company, this is a classic example of a cash transaction versus a credit transaction. Cash transaction versus a credit transaction. So I would like you all to take down this quickly in a piece of paper or in your handout itself. I hope the board is visible. Is it visible to you all?
Yes.
Right. So with the technology, I think you don't need to take down also. If you can just take a photograph of your screen also, or a screenshot if you are using your mobile phone or maybe any other device. So do you all have any questions in understanding this cash versus credit? Because you need to be very clear with this before we go on with the prime entry books or the books of prime entry. If you have any questions, please raise. You can send me a chat. You don't want to ask. If there is a question, just you can raise it. Okay, so let's move on. So as I told you, the cash versus credit transaction, where in a cash transaction, the buyer chooses goods to be purchased and the payment is made immediately. In the case of credit transaction, you offer credit. Credit is where you say pay within 60 days, pay within 90 days, pay within 30 days, whatever. So you are offering credit to the customer, and the payment is made at a later date than the delivery of the goods. As I told you in this example, ABC company will take the goods and go today, but they will pay later. They will pay later. So this credit is normally given or offered for customers who have been doing business for a longer period and very well known, because you are taking a risk. You are giving some goods today. This toy company is going to give goods today for somebody. If this person, ABC company, is not known to them, then they are at a risk. So normally they don't take that amount of a risk by giving $2,500 to somebody who is not known. So normally they do credit transaction with people who they normally know. So what is the purpose of prime entry books? Prime entry books are the books which are used to record all the T accounts. So T accounts we have already learned. Now here comes the books where we are going to enter all the T accounts. The expansion of the business. So over the years, or maybe over the decades, you know, the business transactions have immensely increased. It has become very large and huge. So as a result, the number of accounts that you have to maintain also have become or grown to a greater level. So therefore, the T accounts that you are going to use in a normal business concern like the toy company here are classified into 3 ledgers. We call them as ledgers, and 7 books. 2 key terms. 3 ledgers and 7 books. And these 7 books are going to be known as books of original entry. Books of original entry. What are the 3 ledgers? The 3 ledgers, we call it as sales ledger, purchases ledger, and a general ledger. Now, at this point in time, I would like you to take a note, because in a bank, how does it work? Are we doing this? No, we are not doing all these stuff, because today we are in a computerized environment. We are not going and doing any T accounts as you learn in this chapter. And we don't even identify these ledgers. There is no sales ledger for us. There is no purchase ledger for us, but there is a general ledger. There is a general ledger in your respective organization, which is the banks. But the 7-day books and so on is not commonly known or used in the context of banks. So what we learn here, you need to understand, it is for a normal company who is like these toy companies or maybe manufacturing companies, because it is for them, this is very important, because they are involved in the field of selling goods either on cash or credit. Therefore, for them, it is very relevant to have the sales ledger, purchase ledger, and so on. What will happen? They will even go to the extent of having these sales ledger, purchases ledger in a computer system. So we are learning here the manual bookkeeping method, but actually speaking, in today's context, people will have these sales ledgers, purchases ledgers in their respective systems. So I would like you all to take a note or make a note in a sheet of paper to know that what happens in today's context. Okay, so you may take down. In today's context, most of the companies most of the companies, in today's context, most of the companies use computer systems, use computer systems, use computer systems to maintain their accounting records, to maintain their accounting records. As a result, the sales ledger, purchases ledger, and the general ledger are maintained in the computer systems itself. In the computer systems itself. Okay. So let me actually I should have told you all this at the beginning. Even though we do an online class, I would like if you can have an exercise book alongside you, to whenever you can take down notes whenever I dictate something like this, or in the handout itself if you have already printed, to make notes of these kind, because as we go on, you know that the ultimate objective is to prepare the financial statement. So by this time, if you have started using a CR book or whatever, then it will be easy for you to continue that. When you do the final revision, it will be easy, because we will be doing questions and everything. You can do it in the exercise books itself. So preferred if you can start using a CR book rather than a small exercise book, because we will use that to prepare the financial statements or maybe other questions that we might do in the class. Okay. So what is the usefulness of source documents? So you need to know that every transaction that we enter into, even in the banking or in the maybe in the normal companies, they have to make use of certain documents to justify the transaction or to prove the transaction. So what are these type of documents? This being the basic document for the transaction, that is, it is going to be the evidence of the transaction. It acts as the proof for the occurrence of the transaction. So if I am to give you a simple example, a customer comes and deposits money in the bank. So you expect the customer to fill in a deposit slip and to hand it over to you, and you will have a validation on the deposit slip and you will give it back to the customer. So what does this mean? The transaction is evidenced by the deposit slip, where you will also have a record, and the counterfoil is given back to the customer with a validation, that is to confirm that you have accepted the cash. So the source document here for the transaction will be the deposit slip. It also acts as a basis to record the transaction in the books. In the books means we are talking about the manual bookkeeping, but even in your systems, when you record this transaction, the evidence will be the deposit slip. So this is the example that I am talking about. Cash deposit by a customer, you know that it is a deposit slip. Cash withdrawal by a customer, you will have a withdrawal slip. And suppose if the bank is going to purchase stationery for its own use from a supplier, you will get something called an invoice from the supplier. So these are few examples of source documents which are relevant for banking. But we need to understand what would it be for a normal business. So as you know, we spoke about 7-day books, 7-day books, 3 ledgers and 7-day books. These are the names of the 7-day books. So what are those? Cash book, petty cash book, sales day book, purchases day book, sales return day book, and purchases day book. Sorry, the last one has to be purchases return day book. There is a mistake. I hope you can correct it. Purchases return day book. Purchases return day book. Okay, and the last one is known as the general journal. So for the sales return day book and the purchase return day book, we use another alternative term which is called the return inwards and return outwards. So these terms or the names you have to be familiarized before we go into the exam. So the 7-day books are cash book, petty cash book, sales day book, purchases day book, sales return day book, and purchase return day book. And the last one is the general journal. And this shows more or less a snapshot of all the possible transactions in a business concern like this toy company. We call them as credit sales, credit purchases, return inwards, return outwards, cash and check receipts and payment, and all other transactions. How these transactions will be routed is through the 7 books that we learned. Sales journal, purchases journal, return inwards journal, return outward journal, cash book, and petty cash book, and the final is general journal. So you need to know that these 7-day books can be used with various names. They can be called as sales journal, sales day book. Any name can be used in examination. So you need to know all the names relevant to these. So instead of saying sales return day book, you might say return inwards day book or return inwards journal. All the alternative names have to be known. And finally, the transactions that are resulting in all these 7-day books goes ultimately into the 3 ledgers, namely sales ledger, purchases ledger, and the general ledger. And these are the source documents that you will make use of in each of these scenarios that we looked at now. The sales invoice, which goes into the sales day book, credit notes, sales return, purchase invoice, purchase day book, credit notes, purchase return, receipt payment voucher, petty cash vouchers, financial correspondence. So all these you have to remember, because in exams sometimes you might be required to do the transaction and the source document and where the primary books is. So this table is very important because you need to know in exams, if you are asked to write the day books with 1 examples for each the source document, you need to do this particular table. So you need to know that how it. So when you go to the transaction level, we know that there will be several T accounts. Now, how these T accounts can be classified? So broadly, the 3 ledgers will have accounts, that is the T accounts. These T accounts can be broadly segregated into 2. They are called personal accounts, and impersonal accounts. So the personal accounts will include all your sales transactions and purchases transactions. The impersonal accounts will relate to all your other transactions other than sales and purchases. So you need to understand how this works. The T accounts are created for personal accounts as well as impersonal accounts. And the personal accounts directly relate to the debtors and creditors, which I will explain now. These are all impersonal accounts. In other words, I can classify this like this. The personal accounts are all relating to credit transactions. The personal accounts are relating to credit transactions. The impersonal accounts are relating to credit as well as cash. Credit as well as cash. So before we go into the sales journal, let me explain this example further. So I am going to take out this part out because it is a cash. Now this is the transaction that we are going to look at. So here you have the toy company and the ABC company. Okay, and the transaction is very clear. He's the wholesaler, 1,000 rupees per unit. It's a credit transaction, $2,500. Within 60 days he has to pay. All that is clear. Now, if you are going to look at this transaction from the point of view of the toy company. Okay, I'm not looking at the point of view of the ABC company. So we are looking at the day books of the toy company. Okay. So what have happened here? The toy company has sold $2,500. So which means, let me name these two as this is A and this is B for simplicity. So there had been a transaction between A and B, and you know it is a credit transaction. So we call this transaction as a sales, or in other words, we call it as a credit sales. Credit sale. So A has done a credit sale to B. A has done a credit sale to B. What is the agreement? Pay within 60 days. So pay within 60 days means this is called the credit terms. Okay. So A becomes the seller and B becomes the buyer. A becomes the seller, B becomes the buyer. Now we are talking about the point of view, which means the point of view from the point of view of A. Now, if I am recording this transaction in the books of A, this is a credit sale. This is a credit sale. So automatically, if this is a credit sale, the buyer becomes a debtor. We call that as a debtor. Please remember the term. When I sell goods on credit to another party, the buyer becomes a debtor to me. The buyer becomes a debtor to me under this credit sale. Under this credit sale. Okay? This is, let's say this is A's point of view. Okay? So this is a credit sale done between two parties. A is the seller, B is the buyer. So automatically, B, the buyer becomes the debtor of A. Now I'm going to look at the same transaction. Okay, so I'm now going to look at the same transaction from B's point of view. Earlier we looked at from A's point of view. Now we are going to look at B's point of view. Again, this is the same transaction. B is the buyer, A is the seller, and it is a credit transaction where it says pay within 60 days. So buyer has to pay the seller within 60 days, and that is to be the credit terms. But now, from B's point of view, this is going to be a credit purchase. We call it as a credit purchase. Here it was a credit sale. Here it is going to be a credit purchase. From whose point of view? B's point of view. Earlier we said from A's point of view, B is the debtor. B is the debtor. Now from B's point of view, A is the creditor. The creditor. These two have to be understood very clearly. In summary, when you do a credit sale transaction or a purchase transaction, when you look at it from both point of view, one person becomes a debtor and one person becomes a creditor. These two vary depending on which point of view that you are taking. When you look at it from the A's point of view, B becomes the debtor of A. And the same transaction, when you look at it from the point of view of B, it becomes a credit purchase because B has gone and purchased from A. So it becomes a credit purchase. The agreement remains same. B has to pay within 60 days. But now A becomes a creditor. A becomes a creditor to B. Now, in summary, for a business concern as a whole, who is a debtor and who is a creditor? Debtor is the person who is supposed to pay money to the business. Creditor is the person to whom the company has to pay. Is that clear? Debtor is a person from whom the company has to receive money. That is in the case of A. And when you look at it from the point of view of B, that is ABC company, ABC company to the ABC company, A is a creditor. Why? B is supposed to pay. So I would appreciate if you can take down these side by side, because this is going to be the framework for us to take forward this discussion on prime entry books. So quickly, if you can take down. So let's go back to the presentation, and I hope you don't have any questions. Right. So with that diagram in mind, let's go into this. What is a sales journal now? Sales journal means sales day book. So who will have the sales day book now? It will be A, because A is the person who has sold goods. So we will take the A's point of view to look into the sales journal. Now, what will the sales journal have? You can see the columns. There will be a date column to indicate when you enter into the transaction. And you will raise a bill. So there will be an invoice number. Who will be the buyer? So for A, the buyer will be ABC company. You see, ABC company. What is the description? Purchase of dolls or sales of dolls, because he has sold 2,500 dolls. What is the quantity? 2,500. What is the unit cost? 1,000 rupees. And what is the amount? 2.5 million. 2.5 million. And what do you mean by total amount is you have to take forward a running balance. So this is only one transaction. Likewise, you will have various transactions with different customers, and you will take forward a running balance, which is called the total. Okay. And you also have the ledger. Ledger means the page number or whatever you can refer it to. And what you do at the end of the month is you will take the total of your sales and transfer it to the sales account, because this is where you will get the total sales for the particular month. Total sales for the particular month. And this is how it would look like. From the sales day book, now we have to generate what is called a journal or an entry, transactions based on the sales journal. So this is where we start recording the first transaction. Under the double entry principle, you know this transaction has twofold. One is where you have done a transaction to sell goods. So which means the sales has a double entry generated. So from A's point of view, you will take the total of the sales day book and you will debit an account called debtors account. And what have you done there? It is your total sales. So you will credit an account called sales account. So you see the involvement of the T accounts here. The transaction, we are talking about a complete month, but if you can isolate this transaction only and see, the total of the sales day book will go into two T accounts. This is the journal entry. We call this as the journal entry. So the journal entry would be debit debtors account, credit sales account, credit sales account. Okay. And we also should know how to record a complete journal entry, a complete journal entry. So looking at this example, we would like to generate, I'm going to raise this. So you can take down based on the above example, based on the above example, based on the above example. The sale of 2,500 dolls, the sale of 2,500 dolls, the sale of 2,500 dolls. Could be recorded in the books of accounts, could be recorded in the books of accounts, could be recorded in the books of accounts using the following journal entry, using the following journal entry. So you know the double entry would be debit an account called debtors account, and the amount will be 2.5 million. So how will we get this 2.5 million? That is $2,500 at the rate of 1,000 each. Okay, so you don't need to write this, but this is the journal. Okay, so you, according to the double entry principle, your debits should be equivalent to credits. What does it mean? First, what you write is the debit. The next is the. So in your exams, when you are writing a journal entry, it has to be like this. The debit and credit should be written in two separate columns. And on this side, you will say what are the accounts involved. So according to the double entry principle, your debit of 2.5 million should confine with a credit of 2.5 million. The two accounts involved are debtors and sales. When you are writing a journal entry, this is called the journal entry. Okay. So of course this part is not required. You can do it in when we do exam questions, you will understand. But more importantly, you have to provide a description here about the transaction. So what is this transaction is about? Credit sale of $2,500 to ABC company, or you can say $2,500 at the rate of 1,000 each to ABC company. This we call it as journal description. Okay, you can say journal description or narration. Journal description or narration. So I want you to take down this because this is going to be the starting point of the first journal entry that you learn. So as we go on, you should be able to generate the journal entry for any transaction, not only under prime entry books, but all in any transaction that we may learn from here onwards. You should be able to generate a journal entry like this. What are the accounts to be debited? What are the accounts to be credited? What are the amounts involved? So the total of the debits should agree with the total of credits. And what is the description of the transaction? So somebody looking at this journal entry should know to what transaction this relates to. So I think you might have come across sometimes when customers come and deposit money in your banks, they might want to put some remarks for them to identify later what this transaction is all about. So that is this. That is what we are talking about as journal description or narration. So the journal description or narration is always very important to identify the nature of the transaction at a later point of time. So I would like you all to take down quickly. So hope you all have taken down this. So this is the same thing that we discussed now. When you have a credit sale, the total here appears under the total amount column transferred to the sales account means this is the sales account, you see, and you will debit the debtors account and you will credit the sales account. And I don't want to start the sales return onwards from here onwards. Let's do it next week because we have only few minutes left. So let us stop here for today. And I want you all to ask any questions if you have before we wind up. If you have any questions, you can do so. You can send me a chat or okay. So I think today, yeah, since we are done, I'll ensure that the screen, I'll write it in the middle of the screen. And a few things that I would like to mention, that is, please ensure that you have an exercise book with you when you are following these lessons online, because I don't see anybody, so it's very difficult for me to know whether you all are taking down or not. So it's your duty to ensure that you are taking down any notes that I may give, to ensure that when you are referring it at a later point of time, you understand. So it's very important that you know what you are taking down and the descriptions. Preferably, if you can print the handout, it would be very nice, so that you can take down notes in the handout itself. Since you don't have any questions, let us stop here and continue next week. Thank you and have a good day.